Warriors of price action and guardians of fundamentals, welcome to Retail Recon. Today's mission, we are heading to the Options Bootcamp. The objective is simple: understand what options are in plain language and what it really means to be a buyer or the seller of an option contract. So, gear up and let's go to work. Before diving into tactics, let's strip this down to basics. An option is a contract. That contract gives someone the right, but not the obligation, to buy or sell something at a specific price before a specific date. That something is called the underlying. It can be a stock, an ETF, an index, sometimes even futures. If you remember nothing else from this mission, remember this. Options are contract, and if you do not know which side of the contract you are on, you are the target. On screen, think of 4 words: right, obligation, price, time. That is the DNA of every option. To stress it again, you are not trading shares. You are trading rights. Shares only change hands if options are exercised, when the buyer of the contract chooses to use that right. To make all the finance bro talk simple, I find it easiest to look at options from the 2 sides of the contract. The buyer, who buys a right, and the seller, or the writer, who takes on an obligation. Let's walk through both sides and explain it step by step. First, imagine you are the buyer. As the buyer of an option, you pay money up front, that is your debit, called the premium. When you are buying, you pay the asking price or the ask. That is the lowest price a seller is willing to accept. Think of it as a price sticker in your local supermarket. Wherever you see the ask, think sticker. That is what I must pay to buy. The price you see is per share, but option contracts are almost always for 100 shares. So if you see an ask of 5.40, you will pay $540 for one contract. In return, you get a right, completely under your control, to decide what to do with it. In most cases, you can use it, sell it, or let it expire. What kind of right you are buying depends on the type of the option. A call gives you the right to buy the underlying asset at a specific price, called strike, before expiration. For example, if you buy a call with a strike at 100, you have the right to buy the stock at $100 no matter where the stock price is at that moment. Naturally, you want the market price to be higher than your strike. If the stock is at 120, buying at 100 is better than buying at 120. That is why buying a call is a bullish strategy and you profit when the stock price goes up. A put is the opposite. It gives you the right to sell the underlying asset at a specific strike before expiration. For example, if you buy a put with a strike at 100, you have the right to sell the stock at $100 no matter where the market is. Naturally, you want the market price to be lower than your strike. If the stock is at 70, selling for 100 is much better than selling for 70. That is why buying a put is a bearish strategy. You profit when the stock price goes down. Important to stress again, as the option buyer, you do not have to buy or sell the shares. You just can if it makes sense for you. The key idea as a buyer is this. Your maximum loss is what you paid for the option, the premium. That money is at risk the moment you enter the trade and it gives you an advantage. Your risk is limited and known ahead of time. Now, you will often hear people say an option is in the money or out of the money. That is just describing whether that right is currently useful. For a call, in the money means the market price is above your strike price, so buying at the strike price is better than buying at the market price. For a put, in the money means the market price is below your strike price, so selling at the strike is better than selling at the market. Makes sense. If the right is not currently better than the market price, the option is out of the money. For now, just remember, in the money, the right would be worth using today. Out of the money, the right would not be worth using today. We will go deeper into call and put examples, break-even levels, and time decay in later missions. This is just your first layout of the terrain. Now flip the perspective. Imagine you are the seller, also called the writer. Think for a second. If the buyer has a right, what do you have? If you are thinking obligation, you are absolutely correct. As the seller of an option, you receive money up front. That is your credit, the premium. When you are selling, you receive the bidding price or the bid. That is the highest price buyers are currently willing to pay. Think of it as the best offer on the table. Just like on the buy side, the bid you see is per share and each contract usually represents 100 shares. So, if you see a bid of 3.0, you will receive $300 for one contract. As the seller, you give the buyer a right and you take on an obligation if they choose to use that right. Let's debrief the selling side by type of option so you know exactly what it means for you as the seller. If you sell a call, the buyer receives the right to buy the stock at the strike. If they have the right to buy, then you have the obligation to sell those shares at the strike if they exercise. With that in mind, which direction do you want the price to go? You prefer it to go down or stay below the strike. If the strike is 80 and the stock trades at 60, it makes no sense for the buyer to buy from you at 80 when they can buy at 60 in the market. Selling a call is therefore a bearish or neutral strategy. You want the stock not to run above your strike. If you sell a put, your obligation is the opposite. When you sell a put, a buyer receives the right to sell at the strike price. If they have the right to sell, you have the obligation to buy at the strike if they exercise. Again, ask yourselves, where do you want the price to go if you might be forced to buy? You want it to go up or at least stay above the strike. If the current price is 100 and you may have to buy at 80, you would be buying well below the market price. In that case, most buyers will not exercise the option because they can sell higher in the market. Let's recap the selling side. You sell a call, you may have to sell at the strike. You sell a put, you may have to buy at the strike. As the seller, there are two key things to remember. Your income is limited to the premium you receive, your profit. Your risk can be large or even effectively unlimited if you are not covered or if you do not have the capital to handle assignment. In tactical terms, when you sell an option, you are volunteering to stand in a specific spot on the battlefield. If the market moves against you, you are still standing there. You get paid to take that position, but you also accept the consequences. Later episodes will break down specific strategies like buying calls, buying puts, and using vertical spreads. For now, the important thing is that you clearly understand what options are and what it means to be the buyer versus the seller. Let's touch on a few common traps without going too deep into the mechanics yet. Treating options as lottery tickets instead of high leverage contracts. The premium may look small, but the potential damage to your account can be big if you oversize or keep firing without a plan. Selling options just because the premium looks good without understanding the obligation, margin requirements, or worst case scenario. Trading options without a position sizing rule and without an exit plan. This is where your risk rules become critical. Forgetting the time is a part of the trade. With options, the clock is always running. One quick note on price before we go deeper in later missions. The premium you pay or receive for an option isn't random. It comes from a mix of the underlying price, how far the strike is from that price, time left until expiration, and how volatile the market is. For Options 101, it's enough to know this. More time and more volatility usually mean more expensive options, all else equal. We will fully unpack the price, break-evens, time decay, and more advanced structures in later missions. For now, it is enough to respect the contract and the clock. Before we wrap up, here is a field card you can screenshot for quick reference. Before entering any options trade, be sure you can answer the following questions. Am I the buyer or the seller in this contract? Is this a call, right to buy, or a put, right to sell? What is my maximum loss in simple money terms? Do I actually want the obligation that comes with being the seller of this option? If you cannot answer these questions in under 30 seconds, you are not mission ready for that trade. Options are tools to shape risk, not shortcuts to riches. Used correctly, they can help you protect positions, express views with less capital, or structure defined risk trades. Used blindly, they can blow up a retail account faster than most stocks trades ever will. You now have a basic map of the options battlefield. Buyer versus the seller, call versus the put, right versus obligation. In the next missions, we'll go deeper. Episode 7 will focus entirely on call options. What it really means to buy or sell a call, basic break-evens, and how time works on that position. If you found value in this mission, lock in your support by liking, subscribing, and following our movement. Thanks for standing watch with me today, and until next time, trade smart, risk sharp, and stay on target.